we know that the equity markets feel more of the headlines in the news and so on, but also fixed income, it's a bigger part of the investment markets and the investment portfolios of Portuguese and Spanish investors and so on. So we are here just to focus on that, fixed income, talking about investment grade, high yield, emerging markets. We have with us Romualdo Trancho from Allianz Global Investors, Sasha Evers from BNY Mellon Investment Management, and Álvaro Antón from Aberdeen Standard Investments. Maybe starting with you, Álvaro, this period of economic shutdown is affecting companies with AAA rating, and as well as it can affect companies with a BBB or even lower. Can we see significant downgrades as a result? And what should investors be aware when facing this kind of risks?
Absolutely. Well, thank you very much, FundsPeople Portugal, for giving us, and I think I speak for all of us, the opportunity to talk about fixed income. As Miguel was saying, it is and should be one of our core investment positions. And in the case, and I will answer your last question, the first one, which is what investors should be taking care about. Well, to be honest, the position that Aberdeen Standard Investment has got right now with all this market shock and all this uncertainty that COVID-19 is creating to the markets is that it's our favorite asset class for this year in the medium to long term. On the short to medium to long term investment grade credit, this is a perfect positioning because of the better yield or bigger yield that is giving us right now. The yield has doubled. A stimulus to avoid this COVID-19 scenario will be much greater, so interest rates will go down and down. So government bonds, although we see in the short term a good proposition too, in the medium term, the yield in government bonds will be nearly gone. So investment grade is giving us a 2%, 2.5% yield, and it will be going forward the substitute to government bonds. So that will be my first and foremost conclusion. Secondly, and in relation to what you were saying, how is this situation affecting the companies? Well, it's going to affect everyone because we're going to face the biggest macroeconomic downturn that we've seen probably ever, especially because of the big downturn and big upside swing. I mean, it's been so great that we will see loads of people and loads of companies going down. Why should be taking care? Because governments and fiscal and stimulus, all the stimulus will be only taking care of the higher yielding, higher companies, higher rated companies in the market. So that's one thing. So every and each company that it is downgraded, the price will clearly go down. The stimulus will not be as high or as effective as if you were investment grade. And thirdly, you will lose the faith of banks and governments. So it's clearly very important that the companies stay in the investment grade. I think we will talk later on how the fallen angels will be affected. But for us, it's clear that investment grade with the survivals of this situation, investment grade with the survivals of this situation is our main headline, and that would be our biggest positioning for this year. More in Europe than in US because of the energy sector in the US.
Sure. Sasha, sovereign investment grade has proved to be defensive and is one of the asset classes that's going up even when the markets go down, but it was not immune to volatility. How should investors approach this asset class going forward?
Yeah, the main volatility we saw in sovereign bonds was in the week of the 13th of March. before the Fed came in, we saw a move in sovereign bonds in US Treasury 10-year from about 60 basis points up to about 120 basis points. And that was a real sign of alarm in the markets. That was the maximum peak of volatility. And that was when the only assets that were basically providing you any sort of hedge were the dollar and cash. Even gold was falling at that point. And so when that happened, that was really an alarm bell to the Fed and to other central banks to take action. And the Fed came in and did something similar to Draghi and said, whatever it takes, we will be in there and we will do whatever it takes. And they committed to buying, undefined amounts of government bonds. And then we saw more stabilization in the government bond markets. The bond yields fell back down again towards the 60 basis point level. And since then, we've really seen, much less volatility in government bond markets. We do believe that government bonds provide a hedge to risk assets. So if you're managing a multi-asset portfolio and you're approaching the current scenario, there are obviously three economic scenarios. You have a V-shaped strong recovery in the second half of the year. You have a U-shaped recovery, which is delaying the recovery to next year. And then you have the most pessimistic, which is the L-shape, which is suggesting a depression. Sure. Our scenario is it's probably between a V or a U-shaped recovery. But even if it's a U-shaped recovery, to some extent, markets are factoring in our view, probably a V-shaped recovery currently. And you probably want to have some hedging assets. Markets are going to be volatile. And government bonds, although in theory they are unattractive at the levels of 60 basis points in US Treasury 10-year and German Bund at minus 40 basis points, those are not attractive levels for long-term investors. In government bonds, nevertheless, they serve a kind of anchoring role in the portfolio. So we would say to clients, yes, government bonds have a role in a multi-asset portfolio, hedging some of your risk assets.
Sure. And even being negative, they can go even more negative.
Correct. If you have a deflationary scenario, we're currently, basically we're seeing very strong deflation. Now, if you have a strong recovery, a V-shaped recovery, bond yields are going to go up. But if you have a more U-shaped recovery, bond yields are probably going to stay low, and you'll see risk-off events, and maybe bond yields can go lower in government bonds. And then in an L-shaped recovery, deflation is full on, and that is not a scenario we would put much probability on. But nevertheless, you have to prepare portfolios for different scenarios. You probably don't want to be overweight government bonds. You probably want to be overweight investment grade, just as my colleague at Aberdeen, Standard Life Aberdeen mentioned. We agree with his view on investment grade being an attractive area. But nevertheless, having some government bonds to anchor a portfolio in our view makes sense.
Sure. Romualdo, what will be the biggest consequence of this huge growth in debt as a result of stimulus? And how should investors look at the peripheral sovereign debt in comparison to core debt?
Yeah. Well, first of all, thank you very much, FundsPeople and Miguel, for scheduling, organizing, and this webcast, and also to all of you for attending this amazing fixed income webcast. Well, first of all, consequence, of course, we see consequence. First of all, in government debt to GDP ratio will rise to levels not seen since Second World War, and also central banks and governments will be working much more closely together in the future. Governments, as they don't manage the monetary policy, they will manage and they need to develop expansive fiscal policy going forward. And regarding central banks, with this amount of growth of debt regarding the stimulus, will need to explicitly the forward guidance on the future policy actions, and they probably maintain steep yield curves to support lending to the real economy. And it's happening in Japan with the 10 years maturity bonds for last year, and also it's happened during the Second World War with the US Federal Reserve. It's true that without government help, many businesses will not survive more than a few months, so it's needed. And also it's also true, as we are saying before, that the demand for prime government bonds set to remain strong in this current market environment, obviously as a safe haven status. And also it's true that the central banks, well, it's important that the news we knew yesterday is coming from Germany, when they asked for the previous bond purchasing program developed by Mr. Draghi and the ECB. And let's see what is the result in the coming 3 months. But it's also true that the central bank has expanded the security purchasing programs in order to support different type of assets, and they are supporting not just the capital markets, also the economy, no? So it's important. Regarding peripheral European sovereign debt versus core, well, as I said before, the German news is important to see the future development with the central bank's program, specifically with the ECB. And let's see, it's also important when we are talking about peripheral countries, we are talking about Spain, Portugal, and Italy. In Italy, we saw very recently the downgraded by Fitch and a confirmation by S&P. Let's see what happened with Italy. You know, the amount of debt is 2.4 trillion debt. So between investment grade and high yield, the impact will be important. And also a common factor during this crisis, the COVID-19 crisis, is that all the peripheral countries or nations are very impacted by the tourism, for instance. You know, we are a huge part of the GDP of our nation are coming from tourism, and because of the lockdowns of the different countries, we are probably see close to zero. And we recently see the GDP figures from the first quarter. It was terrible, and let's see figures in the Q2. So it's important. Regarding the core countries, of course, if you need yield, it's not the place to be, but if you need a place to for diversification within your portfolios, obviously the core government debt is the place to be in this volatility market scenario.
Sure. Going into more the high yield theme, Sasha, we saw in March investment grade corporate credit behaving much like the high yield credit or other lower grade credit segments. How much of that do you think it was as a result of the lack of market liquidity, and how important is liquidity when you're investing in high yield?
Yeah, I suppose it's a mixture. It's hard to separate liquidity and solvency issues, no? But obviously, what happened was a big blowout in spreads in investment grade. Factoring in that you were going to get downgrades. Obviously, investment grade, you don't talk about necessarily, bankruptcies can happen, but unlikely. But you do have a lot of potential, what we call zombie companies in the investment grade space, who are vulnerable to being downgraded to fallen angel status. And so, given that there were already a lot of companies before the coronavirus with certain, particularly in the investment grade space and the, triple B area that were, vulnerable to being downgraded, it was obviously felt that, that coronavirus pushed things over the edge for a number of those companies. And we saw downgrades in the investment grade area, companies like Ford, that were downgraded, to fallen angel status. But obviously liquidity, that was a major part. We saw illiquidity. I mentioned we saw illiquidity in the government bond markets, which is very unusual. So grade, clearly a more fragmented market. We saw liquidity there too. And I think that what we've seen, since then, since we've had this, it's very unusual for the Fed. I mean, the Fed in its history has never committed to buying investment grade credit. And then for the Fed to go one step further and say they're buying fallen angels in even high yield ETFs, that's a big step to support the credit markets. And clearly when that happened, you saw credit spreads start to narrow again in high yield, but more dramatically, probably proportionately in investment grade, because they've retraced, more or less half of that spread widening has now been retraced. So you're in a situation where, credit is well supported by central banks, and the sentiment towards investment grade has changed radically. You even have people coming to the market now in the investment grade space. So you're seeing new issues as well in the primary market. So clearly, you know, that is changed dramatically. We expect, you know, with high yield, you have to be selective. We do see opportunities in high yield, but it's more about picking the right issuers. And investment grade, clearly there's still some vulnerabilities to, you know, companies to be downgraded, but the general tone of the investment grade market is good. So, you know, investors typically, what we saw in 2009, investors stepped back initially into investment grade before moving back further into high yield. That may be a pattern we'll see, but we see opportunities in both investment grade and high yield.
Sure. Romualdo, going back to you, and since Sasha introduced the theme of the falling angels, the size of the triple B part of the market was already a theme for a long time. Can we see soon enough a huge double B, you know, segment resulting from downgrades?
Well, this situation remembers me the spaghetti western film, you know, the good, the bad, and the ugly. In order that, for sure, active security selection is key, because we need to differentiate between falling angels and falling knives. You know, falling angel, or if you are a passive investor, you could be forced selling or forced buyer. You know, but if you are an active investor, rather than a threat, we consider this situation as an attractive opportunity for canny investors. You know, the idea is to exploit the price dislocation in the transition of ratings between investment grade and high yield. This often dislocate prices, and of course, as I said before, create good value opportunities. We've seen different forecasts for rating agency, and one of the most pessimistic one is saying that around $900 billion of falling angels in the coming downgrade cycle. So it represents more or less 45% of the whole high yield market. Of course, the impact could be huge, but if we follow an active process in order to determine which are the securities, the issues you want to invest in, probably the opportunity is here. We made a research, it was mid-April, and more or less considering not only the portfolio carry, also if you add the net capital gain for a very diversified falling angels, considering that almost 30% of falling angels over the next 5 years will become again investment grade. If we are able to find those opportunities in the market, of course, the opportunity is here, and the risk you are assuming is not so much.
Sure. Álvaro, we've seen some, it would be funny if it would not be so tragic, the situation that happened with oil and the, you know, negative oil for some short time. How is this oil price impacting the high yield market in general? And as Romualdo was saying, how important is it to be selective when investing in this segment of the market, especially in the oil companies? You have the microphone turned off.
Apologies. Absolutely. I think the oil is one of the major, or one of the biggest situation on high yield, because especially of the US energy sector, which is one of the most defensive portfolios, or more risky portfolios, let's say, not defensive, where we have to be more selective and defensive, is one of the most riskier portfolios. I think it's also good to compare the situation between 2007 and 2020. We compare both, and the situation is, or our conclusion is, that the companies has got, according to what Sasha and Romualdo have said already, the companies have got a really small space before downgrades, or to avoid the situation that they are living. As I was saying before, the most riskier space for us will be triple C's and below ratings. Why? Because is going to be much more affected by the oil, by the leverage. The leverage is much greater between 2007 and now. The investment grade indices and high yield indices are much more related to oil companies, to energy companies, to basic resources, chemicals, etc. And that's going to also to be affected by oil. So as you were saying, and as we've mentioned before, the oil has got a downgrade of 70% in price in 1 year, more or less. And is one of the most significant parts of all the energy, chemicals, basic resources companies. So as I was saying before, survivals is what we need, and anything below those survivals, those supermans that we find within the spectrum, that's going to be a key message. And the oil, as I was saying, is going to be critical for those energy companies.
Sure. Romualdo, and oil and emerging markets, or some emerging markets go together with oil as a theme. What are the emerging countries that you see that will be more affected by this oil situation, and where do you find the most opportunities in this emerging space?
Well, emerging markets debt as an asset class is maturing. The situation now is very different than it was probably 2 decades ago. You know, using the MB as an index, half of the emerging market universe are oil exporting nations, and the other half are importing nations. So the effect of a fail in the oil price is not bad, as a general rule, as may have been 10 years ago. You know, it's true that credit rating agency has already started their assessments for emerging markets debt, corporate and sovereign, initially focusing on oil exporting nations. They started, for instance, with Mexico and Pemex, Colombia and Ecopetrol, and they retain the investment grade. But for instance, in Africa with Angola or Nigeria, they have an issue there. Regarding the current situation today, the US denominated debt for all emerging markets, including China is close to 4 trillion, but the ratio of government debt to GDP ratio for all emerging markets is at highest level in decades. But what is important today is that we need to know that around $700 billion in emerging markets debt needs to be refinanced in 2020, and more of them, 80% of them in US dollar. So we need to be very careful when we are talking about emerging markets. Again, active investing approach is key in order to select which sovereign debt and which corporate debt are the one we want to include in the portfolio. And we need to avoid those issues that are more dependent on external capital. For instance, Turkey. Which country do we like the most? Now, Mexico, Brazil, and Indonesia, for instance.
Sure. Álvaro, what are your favorite emerging markets for debt investing?
Well, right now, I mean, I think it's more than the companies than anything else. We still believe that the first step for emerging markets, we have to be very selective, but we have to also to be diversified. Latin America has been hit the most, and we are overweight in Latin America and underweight to Asia and overweight to Middle East, where we've seen Middle East and Russia, where we've seen a more stability or more stabilized situation on corporates, U.S. hard currency. And I think that is the area where we should be focusing now. Emerging markets, corporate, always debt in hard currency. Looking to diversify portfolios, as I was saying before, between Asia, Eastern Europe, South Africa, and Latin America, and that's where we are seeing a more interesting situation. And why now? Because we've seen massive outflows, and we're seeing a very attractive yield of around 7.5%, with a duration of 4 years. I think we are in a situation whereby we have to be quite diversified. As Romualdo was saying, the asset class is really becoming to be mature, and it is a much bigger market than the US high yield or the European high yield. And we believe that this is where the situation will give us more potential. There's also the possibility to go local currency or governments hard currency or local currency, but that has been hit the most. And as we've seen since 2018, 2015, etc., on all the recent crises, we've seen a much more volatility situation in governments' hard currency and local currency, or local currency reserves and interest rates, than in hard currency corporates, and that's where we be focusing in emerging markets, hard currency, in corporates.
Sure, and Sasha, since Álvaro rose the subject of hard currency versus local currency, how do you think it's best to approach this asset class, and where do you find most value?
Yeah, I mean, just to mention one thing that we perhaps haven't mentioned is obviously the dollar. I know that is a key factor in all this.
Sure.
If we look back at what was happening in March, the main worry, okay, you had oil, you had a perfect storm, you had the coronavirus starting to break in emerging markets, you had those, obviously oil, particularly for those countries vulnerable to the oil price, but then you had a dollar that was strengthening very rapidly. And probably the third of those is probably the biggest risk for emerging market debt, because obviously when you have a mismatch between your funding and your debt is in dollars, but your local currency is where your basically revenues come from, that mismatch, we saw it in the Asian crisis in the 90s, when you get a big blow up, when the dollar is very strong and the currencies, local currencies in those emerging markets weaken, then that creates an enormous stress on emerging market debt. So what the Fed has done by, opening swap lines with the central banks in emerging markets helped a lot alleviate the strain and to help them with their dollar funding. Just wanted to mention that because I don't think we talked about the dollar in all this, but any strengthening of the dollar is going to cause issues for emerging market debt. So back to the question on local currency debt. Local currency debt has been more recently generally a worse performing asset class. We would say that emerging market debt in local currency is probably an asset class that until you see signs of a stronger recovery, may be more under pressure. But I agree with my colleagues that it really depends on which country and how much they depend on external funding. But certainly, if you get a bounce back, so if you get a V-shaped recovery, you have a lot more upside in local currencies, because on a valuation basis, a lot of those local currencies are very cheap. So if you're looking for an asset class to play a strong recovery story, emerging market debt and local currency will have more upside in our view than emerging market debt in dollars in a V-shaped recovery type of scenario. The emerging market debt in dollars has a very wide spread and is attractive also on a valuation basis. Obviously, it's more linked to the US Treasuries, and we would say local currency is linked both to European Central Bank and also to US Treasuries and US and the Fed. So is perhaps a more diversified asset class for a euro investor in that respect. We would be selective in local currency and in hard currency debt. We would be playing more senior debt. We would go for issuers that had higher quality. In emerging market debt in local currency, we like Mexico, we like Peru, and we like Qatar, some of the Middle Eastern countries, so higher quality, less dependence on external funding or countries that have some fiscal room. Emerging markets have an added problem I haven't mentioned, which is they don't have the fiscal room that we have in the developed world. And so, stimulation, fiscal stimulus from those emerging market countries will be more selective and harder to come by than we see in the developed world. So we would be cautious on the asset class, be very selective, wait for stronger signs of recovery, and then we can play the asset class out perhaps more aggressively.
Sure. With all these ideas and visions that you expressed, Álvaro, what would be the single, if you had to elect one, the single best strategy for investors to approach fixed income markets in this context?
For us, as I was saying initially, in the short to medium and also to long term, we would be being Portuguese and being European investors, we would be choosing European corporate investment grade credit, and that would be through the fund Standard Life European Corporate Bond Fund, where you also have the sleeve, an additional sleeve of SRI. So it would be the Standard Life European Corporate Bond Fund, Sustainable and Responsible Fund. So those two would be our biggest positions right now. Why? Because with a duration of a bit below five years and a yield of 2.5%, the team managed or directed by Craig McDonald, who has been running the show or the fund since 2003. So it's nearly now 20 years of a fund track record. Is a fund with a very low tracking error to the index. As I was saying, it's got a nice yield, an interesting approach, a volatility below 3%, and is basically positioned to the stimulus, to get all the stimulus from the central banks and fiscal stimulus that we are going to see from the countries and the different fiscal governments within the countries. It's positioned more in the northern side of the countries in Europe, and also it can invest in US companies that are always issuing in euro investment grade debt. For example, as I was saying, United States with a 17%. Is basically based on financials and insurance companies, and in the more secure part of the debt of those financial and insurance companies. It's also has got a bit of corporate hybrids with a good opportunities that we're seeing in corporate hybrids, and is not out, but really underweight to oil companies and autos. Is a fund that has overperformed or done better than the index since 2003 in all years, with the exception of 2007. Has protected more in the bad years like 2008, 11, 15, and 18. It has done better than the index, and we think we say it in Spain, a fondo de armario is a main fund. Is a main fund to have. And there's a great track record to talk about.
Sure, Sasha, what do you think should be the strategy that would best position investors in this exact moment?
Yeah, it's difficult depending on their risk profile. So if we go to a kind of more medium type of risk profile, we have a solution which is called the BNY Mellon Global Short Dated High Yield Fund. So what we're saying is, we think that there's opportunities in high yield, traditional long duration high yield, but if you want a more conservative approach to come back into the high yield market, the short dated area is interesting because we were talking about refinancing issues in the area of fallen angels, but actually short dated, if we look at the next year, the short dated area, we don't see big refinancing issues for the companies that we're investing in or the year after. So we don't have those refinancing headwinds in that space. So the advantage of buying shorter dated paper is that you have more visibility over whether the cash flow can meet the coupon. And when you go out to longer dated paper, it's really much more about the business itself. No? So if I'm buying short dated a 6-month paper or 1-year paper, even 18-month paper, then you have to make sure that the cash flows can meet my coupon. And what's the added advantage of a short-dated approach in this market? It throws off a lot of cash. So if you've got paper constantly maturing, you have cash on hand to invest in great opportunities. And right now, it's a great time to have cash because there are a lot of opportunities out there. So you have a strategy that's naturally generating cash, like a short-dated high-yield fund. That is an attractive proposition in these volatile markets. The third thing I would mention is the yield. You know, not long ago we were getting a 3.5% yield. We're getting an 8.5% yield. So we have like a duration of 1.5, and we get a yield of 8.5% on a fund that has half the volatility of traditional high yield. Well, it could be a good idea for investors that are coming back to the high yield markets but want a slightly more conservative approach. The last thing I mentioned, because it's global, you know, we have a little bit of EM corporates in there. We have, you know, obviously Euro, high yield, short dated, and US. So we can allocate around that where we see the best opportunities. And, you know, right now there are, you know, it's a lot of volatility, and also there will be different opportunities in different markets. And a global approach gives you a bigger spectrum, a bigger universe to select from. So the BNY Mellon Global short dated high yield is perhaps a more conservative way of coming back to the high yield markets.
Sure. Before going to Romualdo, if I ask the audience, if you have some questions, please leave them in the Q&A section of Zoom. It's in the below part of the tool. So Romualdo, in your view, what's the single best strategy to approach fixed income markets at the moment?
Well, a fixed income investor is looking for yield and for diversification. Well, with Allianz strategic bond, you know, it's a strategy designed to be different. We seek not only outperform our global bond benchmark, which is the Barclays Global Aggregate Index. The idea is also targeting a zero correlation with equities, because with many global bond funds actually behaves more like funds. You know, the idea is a total return focused strategy with a global macro investment process, contrarian views, high conviction ideas, etc. 4 global sources of alpha. The first one is rate. It's very flexible, it's unconstrained, it's active, of course, and in rates, in terms of duration, between 0 and 12 years duration, and all the yields curves across the globe. Regarding credit, the only legal limit is 50%, 50% in high yield, and opportunities across the credit rating spectrum. The third one, the third alpha engine is inflation, and we could use inflation-linked bonds or inflation swaps. And the last one, but not the least, is currency. We are using FX not only for active FX positions, also to hedge portfolio tail risks. You know, the current position today is regarding rate. For instance, we are overweight in US, underweight Eurozone. We sold all the emerging markets, and we see US curve steepening. Regarding credit, we are short Spain and France, very long US dollar investment grade, and long Euro investment grade, and 10% Euro high yield. Why Euro high yield? Because the lower exposure to energy companies. Regarding inflation, we've recently opened a position long 2 years and 5 years US inflation. And regarding Forex, you know, it's not only to hedge portfolio tail risks. We see now, or we are long Japanese yen and a small long in US dollar, and we are short emerging markets and British pound. The best proof of concept of this strategy is, for instance, this year, 2020, the performance year to date, net performance for the Euro hedge share class, as the base currency of the strategy is US dollar, the performance is plus 19%, 19. So it's a way to play the full spectrum on opportunities we've been commenting during the webcast: government bonds, US curves, credit, emerging markets, rate, inflation, etc., in order to provide a very diversified strategy with a consistent performance over the years.
Sure. Many thanks from all. Let's go to some questions from the audience. Maybe I'll start with Sasha. What is your view on inflation and inflation-linked bonds across different developed countries in short, mid, and long-term perspectives?
Yeah, I mean, it's a great question. I mean, I think that definitely there is a sense that inflation is, so let's say that the inflation optionality is cheap. So if you are buying inflation-linked bonds at these levels with very high deflationary expectations, then you know that. Sorry, I think the camera is going to. Sorry, yeah. No, I'll carry on. I think we've got a problem with Alvaro's camera there.
No, it's fine from here.
Sorry,
Apologies.
So what our scenario is that it could well be that all this fiscal stimulus and all the central bank hyperactivity could in a second stage create inflation. I think a lot of it is linked to a possible V-shaped recovery. So if we go into a much longer period of recovery, probably deflation or the deflationary scenarios extends much further in time. But certainly at these levels, if you're buying inflation-linked bonds with all the factored in deflation expectations, you get a cheap option in some senses. So we think it's good to start, particularly if you're managing a multi-asset portfolio, it's good to start to build in possible inflationary scenarios. We've never seen anything like what we're seeing now in the history of mankind in terms of in terms of both fiscal stimulus and central bank stimulus. Will that in the end, you have two forces, you have deflationary forces, but these potential future inflationary forces. At these levels, you buy inflation-linked bonds at very cheap levels. Why not buy some of that optionality, particularly if you're managing a multi-asset portfolio or a flexible fixed income fund? So we are doing the same as what Romualdo mentioned, which is we're buying some of that inflation optionality.
Sure. Romualdo, are there sectors in the high yield space that you completely avoid?
No, because the reason is we are active investors, you know, and we don't exclude in advance any sector or any company. The idea is to find those opportunities with the right management, with the right balance, with the right cash flows, etc., in order to provide consistency in high yield. But if we could say, for instance, that we avoid the energy sector, for sure in the energy sector, we will be able to find great opportunity to invest. So no, we don't exclude any sector in advance.
Sure. Álvaro, what about the SRI approach to fixed income investing? Can it reveal itself as a more defensive way of investing in this context?
I think so. I totally think so. Not only, I mean, in this case, the greenwash is a clear greenwash because it has worked in terms of numbers and in terms of performance has worked better. I'm just looking at the numbers just now. And if we look, we launched the fund in 2011 due to a request of institutional investors in the Nordic countries, basically pension funds. And basically the fund is excluding weapons. It has to invest in the UN principles of investment, the 17 principles of investment of the UN, United Nations. And it's clearly, as I was saying, excluding weapons, alcohol, is excluding all types of sectors that are not, let's say, welcome. So in that case, it's going to reveal as an asset class because since 2011, pension funds in the Nordics have been pushing for us for that. And we're seeing a more pushing trend within Portuguese clients too, Portuguese and Spanish clients. So it's clearly pushing and revealing positive. In terms of performance, as I was saying, this year in the first quarter has performed 10 basis points better the SRI sleeve than the non-SRI sleeve, and both funds have got 80% of overlap. So, I mean, it's clearly the SRI performing a bit better. And if we go back in time, we would see that in 2015, due to the Glencore crisis, where the SRI funds perform better because pension funds are normally, who are the investors of this type of assets, are more stable. And also Glencore was a non-SRI company, which impacted the normal investment or the non-SRI corporate credit. So it's clearly performing better in numbers and also in stability. And it's something that more and more clients are investing for it, and especially after this COVID-19 or coronavirus crisis, where we think or we believe that companies will be here for a reason and will have to be much more social. They were in the part of government or balance sheet, etc. They were a bit better, but more and more the companies will be evaluated on the social part and how they are retributing the different citizens in the different countries.
Sure. Just one last question to end, maybe to Sasha. What do you think of convertible bonds as an opportunity?
Convertible bonds, obviously, those bonds that have more fixed income exposure. So, you know, obviously you have convertible bonds that are more equity orientated or more fixed income orientated. But I guess in the context that we're discussing here, fixed income, so we'll assume it's more those that have a fixed income bias. Yeah, I mean, it's an interesting area. We don't actually have active management in this space. It's not our core part of our kind of core expertise. So I would prefer to hand that question on to one of the other.
Okay, if anyone of you want to grab the question. If not, don't throw yourself under the bus. So I guess we got to the end of the time. I want to thank again to everyone that's been attending the seminar. We got almost everybody to the end. Many thanks also to Romualdo Trancho from Allianz Global Investors, to Sasha Evers from BNY Mellon Investment Management, and Álvaro Antón from Aberdeen Standard Investments. Many thanks for being here. Many thanks for your insights. I guess they were very valuable for everybody listening. And stay safe and be healthy. See you soon. Bye-bye.
Muito obrigado.
Bye-bye.
Take care. Bye-bye. Bye.
Take care.